Hey everybody, Chris here from Project Finance. So I just spent over 10 hours putting together the best poor man's covered call examples so that I can show you exactly how this increasingly popular option strategy works and why it's so amazing. With the stock market plummeting right now, I thought this would be a phenomenal opportunity to teach a lower risk alternative to the covered call strategy, which is a super popular option strategy amongst long-term stock investors. The poor man's covered call strategy is perfect for those who want to buy into market weakness but are worried about continued downside. So let's learn exactly how this strategy works and look at some real examples so you can see exactly how the poor man's covered call performs relative to a traditional covered call in various stock price scenarios. The poor man's covered call, or PMCC, reduces the capital requirement and loss potential relative to a traditional covered call by replacing the 100 shares that you would buy in a traditional covered call with a long in-the-money call option. So instead of purchasing 100 shares of stock and shorting a higher strike call option, which would be a traditional covered call, we're going to buy an in-the-money call option in a long-term expiration, and then we're going to short an out-of-the-money call option in a more near-term expiration than the option we purchase. So first I want to show you exactly how to set up a poor man's covered call using Apple options. And then I'm going to walk you through two different scenarios using historical option data to show you exactly how a poor man's covered call and traditional covered call match up in different scenarios. So I'm going to set up a poor man's covered call in Apple. And as we can see here, I have the Apple chart open. And recently the stock price has been declining along with pretty much every other stock out there. So let's say a trader wanted to enter a poor man's covered call. And the reason they might want to do that is because they don't want to have as much downside risk as they would have if they entered a traditional covered call. So I've already kind of pre-selected the strike prices that I'm going to choose for this scenario. So we're going to look at buying a long-term call option with a strike price around 120. And then we're going to look at shorting a more near-term option, specifically a call option, with a strike price around 160 or 165. So I'm going to open up the trade tab, and first I'm going to go to the expiration cycle with 123 days to expiration, which is the September 16th, 2022 expiration. So first I'm going to open up these options by clicking on the expiration, and I'm going to go to the call options, which are on the left side, and I'm going to target the 120 call strike price as I described before. So we can see this option's trading right around $30. In terms of premium, that would be a cost of $3,000. So this is the option I'm going to buy to set up the poor man's covered call. So I'm going to click on the ask price of the 120 call, and this sets up an order to purchase this 120 call option, expiring in 123 days. Now I need to short a more near-term call option, so I'm going to close this current expiration, and I'm going to go to the 60-day expiration cycle, which is the July 2022 expiration. I'm going to open up these options, and now I am going to look at the 160 or 165 call options, and we can see that the 165 call is trading for around $1.60. The 160 is around $2.60. For this example, let's go ahead and choose the 160 call option. So I'm going to short this call option, meaning I will be selling it as an opening trade and effectively betting against its price. So to set up an order to sell or short this 160 call, I'm going to click on the bid price of 261. And now I have my poor man's covered call set up. So we can see that the mid price of this entire position is $27.15. And if we multiply that by 100, we get the total cost in terms of actual dollars we will have to spend to enter this position of $2,715. And on the bottom right here, it says buying power effect is $2,715 debit. This means I will be paying to enter this position. So this would be an example poor man's covered call entry, and the maximum loss potential of this position would be $2,715, and that's the amount of money that it will cost to enter this position. Let's quickly compare that to a traditional covered call using the same 160 short call expiring in July. If I clear this order, I can first set up buying 100 shares of stock, by clicking on the ask price of Apple shares, which is right around $145 per share. If I want to purchase 100 shares of Apple, around $145 a share, I'm going to have to spend $14,500 to buy those 100 shares, and this is in an IRA account, so there is no margin being used. Then if I go to the 160 short call and click on the bid, this sets up an order for setting up this covered call position. Now right off the bat, we can see that the trade cost is $142.45 in option terms, and to get the total entry cost, I just have to multiply that by 100, and we get a total trade entry cost of $14,245. I want to show you real examples to illustrate how the poor man's covered call and covered call positions compare in various stock price scenarios. So I created two historical poor man's covered call and traditional covered call positions on Facebook and SPY, which is the S&P 500 ETF. And I looked at how these positions performed in terms of profits and losses relative to how the stock price was changing. So in this first example, we're looking at SPY, which is the S&P 500 ETF. And I chose a period where the stock price was falling and then recovered to see how the poor man's covered call and traditional covered call positions compared in terms of profits and losses. So the graph right here is exactly what the stock price is going to do right after entering the poor man's covered call and traditional covered call positions, and we can see how these strategies perform throughout these stock price changes. I wanted to set up a poor man's covered call position with a long call strike of $400 and a target amount of days to expiration of 180 days to expiration. Then I wanted to short a 470 call with a target time to expiration of 90 days. So I wanted to buy a 180-day in the money call and short a 90-day out of the money call to create this poor man's covered call position. So the resulting position was purchasing the 400 call in the February 2022 expiration cycle, which at the time had 169 days to expiration. Then I shorted the 470 call in the November 2021 expiration cycle, which had 78 days to expiration at the time. The long 400 call in Feb 2022 was $60.07, and the short 470 call in November 2021 was $3.08 at the time of entering this position. So the poor man's covered call position cost $5,699 to enter, since the 400 call cost $6,007, and shorting the 470 call brought in $308 in premium. If we created a traditional covered call at the same exact time, we'd have to purchase 100 shares of SPY at $453 per share, costing $45,300 if no margin is used, and then we could short the 470 call in the same expiration cycle as the poor man's covered call, and we would collect $300 for shorting that call option, and that would bring our total trade cost to around $45,000. So here's exactly how the poor man's covered call and traditional covered call performed as SPY was changing price over the trade period. As we can see in this graph, the poor man's covered call lost less money when the stock price was falling relative to the traditional covered call, which highlights one big advantage of the poor man's covered call, which is that it has way less risk than a traditional covered call, and that stems from the lower trade cost. So in the poor man's covered call, we are entering that trade for $5,700. In the traditional covered call, we're entering that trade for around $45,000. So there's a ton more risk in the traditional covered call as compared to the poor man's covered call. But as we can see in this graph, the two strategies perform very similarly. And when the stock price started to recover, we can see that both strategies started to profit, but the traditional covered call started to make a bit more money than the poor man's covered call. But overall, their performance is highly correlated, and we can see that they experienced very similar profit and loss changes as SPY was changing. But the big difference here is that the poor man's covered call was entered for about 10% of the cost as the traditional covered call, assuming no margin is used. So at the low in this graph, the poor man's covered call was down $1,600, and the traditional covered call was down around $2,200. And when things were going well, the poor man's covered call reached a high profit of $1,500, and the traditional covered call reached a high profit of $1,900. Now let's look at another example, except this time we're going to look at an example where the stock price absolutely craters right after entering this trade. So we're going to see how the poor man's covered call performs relative to a traditional covered call when the stock price is getting obliterated. In this next example, we're looking at Facebook in early 2022. I chose an entry date of January 22nd, 2022. And at that time, Facebook was trading right around $303 per share. And shortly after, the stock price absolutely plummeted. So let's look at what happened to these poor man's covered call and traditional covered call positions as that happened. In this example, I wanted to buy a 250 call with around 120 days to expiration and short the 350 call with around 60 days to expiration. The resulting position was buying the 250 call in the May 2022 expiration cycle, which had 119 days to expiration at the time of entry. And I shorted the 350 call option expiring in March of 2022, which at the time had 56 days to expiration. The long 250 call in the May 2022 expiration cycle cost $63.48. And the short 350 call option in March of 2022 collected $4.30. In this example then, the trade cost is $5,918. If we created a normal covered call, we would purchase 100 shares of Facebook at $303, costing $30,300. And then we could short that 350 call option and collect $430, bringing our total capital requirement to right around $29,870. Let's take a look at how these two strategies fared when Facebook stock cratered in the coming weeks. Of course, we knew that this was going to be ugly, and the benefit here, as I've described, is that the poor man's covered call suffered significantly lower losses than the traditional covered call in this particular scenario. At the high, right before the market crash, the poor man's covered call was up right around $1,200, and the traditional covered call was up around $1,600. And at the low, the poor man's covered call was down around $5,800, and the traditional covered call was down over $11,000. So almost twice as much as the poor man's covered call in this specific scenario and trade setup. This Facebook example brings up a good opportunity to quickly cover the maximum loss and maximum profit potential of a poor man's covered call. In this Facebook example, the maximum loss potential is the trade entry cost of $5,918 because we are paying $6,348 for that 250 call and receiving $430 for that short 350 call. So if the stock price was below 250 at the time of the long call's expiration date, that means that the short call with a strike of 350 would have already expired worthless, and we would have a profit of $430 on that position, but we would lose $6,348 on the long 250 call if it also expired worthless. So the net loss in that case would be $5,918, which is the initial trade entry cost. The simple max profit calculation for this position is going to be the width of the call strikes less the entry price of this trade. So we have a short 350 call and a long 250 call, bringing our strike width to $100. The trade entry cost in option terms is $59.18. So if I pay $59.18 for a position with a $100 strike width, specifically a call spread with a $100 strike width, if the stock price shoots way higher, then these options are going to trend towards their intrinsic values, and that means that the spread as a whole will trend towards its intrinsic value, which is going to be the width of the strikes of $100. So if I pay $59.18 for a position that appreciates towards $100 if the stock price is gapping to the moon, then my maximum profit potential is going to be $40.82 in option terms, or $4,082 in P&L terms. But this is a very simple max profit calculation because, for example, if the stock price goes right to 350 at the time of the short call's expiration date, then that short call is going to expire worthless and we'll have a $430 profit on that short call option. But that long 250 call option still has lots of time to expiration, and that means that the long call is going to be trading for more than its intrinsic value. So in that case, the PMCC position could have a profit, that is slightly higher than the maximum profit position that I just described to you. The last thing I want to mention is that if you are able to trade multiple short calls against that initial long call, meaning that if the initial short call expires worthless and you're able to short another call in a further out expiration cycle, you're going to collect more premium from that additional short call, and that's going to reduce your maximum loss potential and increase your maximum profit potential on the entire poor man's covered call package. So I hope everything has been very helpful in this video so far. If you're still with me, then great job. You're doing well. At this point, I want to take things a little bit deeper and talk about how implied volatility and time decay impact the profitability of poor man's covered call positions. So how does implied volatility impact the performance of a poor man's covered call position? It depends on many factors, because the tricky part with a poor man's covered call is that we have two options in two different expiration cycles. The first point to mention here is that we're buying a call option with more time to expiration than the call we are shorting. Generally speaking, longer term options have more exposure to changes in implied volatility than shorter term options. And what this means for us as PMCC traders is that since we're buying a longer term call than the one we are shorting, that longer term option is going to have greater exposure to changes in implied volatility than the short call that we're trading that has less time until expiration. But it also depends on where the stock price is relative to the strike prices of this poor man's covered call position, and also how much time to expiration these options have. So in this test, I used a stock price of $300, a long call strike price of $250, and a short call strike price of $350. And this setup very closely replicates that Facebook example that we looked at earlier, where the stock price was around 300 and I bought a 250 call and shorted a 350 call in varying expiration dates. The starting implied volatility was 25%. I then calculated the P&L curves of this PMCC position if we increased implied volatility from 25% to 50%. I know that's a big change, but when you're looking at stuff like this, it's helpful to have a large change in the variable that you're testing for so that you can actually see the differences, versus if I were to go from a 25% IV to a 26% IV, then these changes are going to be much more subtle and it's going to be harder to get a visualization that helps us understand this concept. What we can see in this graph is that first, if the stock price is decreasing and implied volatility is increasing, the position's profitability is much better off compared to a scenario where we had no change in implied volatility. So if the stock price is falling towards that long call strike price, you want implied volatility to increase because your position is going to be positive vega, which means it has positive exposure to changes or increases in implied volatility. On the other hand, if the stock price is surging and implied volatility is increasing, we can see that this would be a less favorable scenario than if we had constant or decreasing implied volatility with the stock price increasing. And that makes sense to me because if the stock price is increasing, then that long call option that we own is getting deeper in the money. Deeper in the money options have mostly intrinsic value and less extrinsic value the deeper in the money they get. And implied volatility changes or the passing of time only impacts extrinsic value. So the more intrinsic value an option has, the more immune it is to changes in time and changes in implied volatility. So with the stock price increasing towards our short call strike price, if the stock price goes right to our short call strike price, then that long call is going to be really deep in the money with very little extrinsic value. And our short call is going to be at the money with lots of extrinsic value. And therefore, if we have a decrease in implied volatility, then we're going to see a much larger drop in the short call's value than the long call's value. And overall, that's going to result in a higher position value or increasing profitability for our poor man's covered call position. I covered this exact concept in my recent video, Vertical Spread Concepts That All Traders Must Know, which you can watch by clicking on the card right up here or by checking the video link in the description below. I would definitely recommend checking out that video so you can further your understanding of how passage of time and changes in implied volatility impacts the profitability of option spreads depending on where the stock price is relative to the options in that particular spread. The concepts taught in that video will generally apply to a poor man's covered call, but as we're discussing in this video, it's a little bit more tricky with the poor man's covered call because we do have two different options in two different expiration cycles, and that makes things a little bit more complex. But generally speaking, the concepts in that other video will apply to the poor man's covered call position in a lot of scenarios. In regards to the poor man's covered call, I can't say that you always want implied volatility to decrease if the stock price is increasing, because it really depends on how much time your options have left until they expire. So moving on, how does time decay, or the passage of time, impact the profitability of a poor man's covered call position? Let's find out. The first thing to mention is that long-term options decay more slowly than short-term options. In a poor man's covered call, we are purchasing a call option that is in the money with a lot of time until expiration, and we are shorting an out of the money call with less time until expiration. That means that we are buying a call option with mostly intrinsic value, and intrinsic value does not decay. And intrinsic value is immune to changes in implied volatility, as I described earlier. So since we're buying a deep in the money call option with little extrinsic value and lots of time to expiration, the little extrinsic value that it does have is going to decay very slowly. So I ran a quick test very similar to the Apple example in this video. So I started with a stock price of $145. I'm looking at a 120 call option with 180 days to expiration, and a short call with a strike price of 160 and 90 days to expiration, and implied volatility is at 30%. So we're going to look at the P&L curves of this hypothetical PMCC position at the time of entry, 45 days after entry, and then 90 days after entry, which is going to be the expiration date of that short call option in this position. If the stock price goes to the short call strike price of 160, that means the long call is going to be deep in the money with lots of time to expiration and very little extrinsic value, while the short call is going to have lots of extrinsic value and less time to expiration. The result is we will have a position with positive theta exposure, meaning that the short call is going to decay more quickly than the extrinsic value in the long call, and that is going to generate profits for us as a trader who owns that in the money call that is decaying very slowly and is short the out of the money call that is decaying more rapidly. So that is going to generate profits for us in this PMCC position. On the flip side, if the stock price is falling and getting closer to our long call strike price or below it, then that means our short call is going to be losing lots of value already. And since it has less time to expiration and it's getting really far out of the money, then its value is going to quickly approach zero, meaning that the passage of time is not going to result in any profits from that portion of the trade. While our long call is going to be becoming less in the money and closer to at the money or out of the money, and at the money or out of the money options have lots of extrinsic value, and that means that our long call is going to be consisting of more extrinsic value as the stock price falls, and it's going to be more exposed to the passage of time. So how do you go about choosing strike prices when you're trading a poor man's covered call? I know strike price selection can be a difficult topic for any option strategy simply because when you open up an options chain, there's so many different strike prices that you can choose from. Well, in a PMCC, I can give you some rough guidelines, but at the end of the day, I would recommend tweaking the strike prices to get a position that you like and is fitting your outlook for that stock price. So the first strike price selection guideline that I'll share with you is to target an expiration on the long call with more than 90 days to expiration and a delta of more than 75 or 0.75 on that long call option. And if I were trading a poor man's covered call, I would probably go between 120 to 180 days to expiration. So let me go ahead and open up the trading platform and show you why I would do that. So first and foremost, I would personally go 120 to 180 days. So I'm going to go to the November expiration with 184 days until expiration. And I'm going to open up these options. And let's go and find the call option with a delta over 75. So right off the bat, I can see that on the left-hand side, I have the deltas listed and I have extrinsic value and theta also listed. we can see that the 120 call option in this particular expiration cycle has a delta of 0.75. This would be my starting point, and with a stock price at $140.70, this 120 call has just over $20 of intrinsic value, which is immune to time decay and changes in implied volatility, which means that the remaining $7.35 of this price is extrinsic. For this, I would probably go a little bit deeper in the money. So I would probably go to the 110 or the 100, because if we look at the 100 call, for example, it has a delta of 0.88, and that means it's going to more closely resemble owning 100 shares of stock. And what that means is if I have a call option with a delta of 0.88, if the stock price goes up or down $1, then the option price is expected to change 88 cents, which in actual dollar terms or P&L terms, that would be an $88 P&L change, which would be the same thing as owning 88 shares of stock and seeing the stock price go up or down $1. So that would be a good thing to own a deeper in the money call, because it would more closely resemble long stock. And also, this option is trading for $44, and it only has $3.50 of extrinsic value, meaning that a much smaller percentage of its price is extrinsic value as compared to that 120 call. And that's good, because when we're setting up a poor man's covered call, we want to buy that deep in the money call option with little extrinsic value so that it can closely resemble owning 100 shares of stock, and it won't be that exposed to time decay, because first, long-term options decay very slowly, and also, since it's a deep in the money call option, it has very little extrinsic value to begin with, so that little extrinsic value is going to be lost over a long period of time, which means on a daily basis, there's not going to be much loss in extrinsic value in this call option, assuming that the stock price remained at the current level. So I would probably target the 100 call for this particular setup. Then I would offer my second guideline, which is to short a call option in an expiration cycle with less than 60 days until expiration. For this, if you're buying a 180-day call, you could short a 90-day call or something like that. But with the short call, you really want that option to be decaying quickly, and options with less than 60 days to expiration are going to decay much more quickly than a short option with 90 days to expiration to start. So you really want to stay within that 60-day time frame when you're shorting that call option. So I'm going to go to the July 2022 expiration cycle, and let's look for a call with a delta less than 35 or 0.35, which means that the option is going to be decently out of the money. So on the left-hand side here, I can see the deltas of all of these call options in the July cycle, and the 150 call option is the option with a delta of 0.34. This strike price of 150 is only about $10 above the current stock price. So for me, that might be a little bit too close, since we would be putting our short call strike right here. And if the stock price rebounds higher, then we're not going to have as much upside potential as if we had a further out short call strike price. So for this, I'd probably go to the 160, and this option is trading for $1.60. And 100% of that price is extrinsic value. So if I short this call, I end up with a 160 poor man's covered call with a long call that expires in 180 days and a short call that expires in 58 days. The entry price of this spread is $42.50, and with the strike width being $60, this gives me an estimated or simple max profit calculation of right around $1,800, since if I pay $4,200 to enter this position and the stock price goes to the moon and this poor man's covered call trends towards the width of the strikes, which is $60, then this position's value is going to trend towards $6,000. And if I pay $4,200 for a position that appreciates towards $6,000, my maximum profit potential is going to be around $1,800. But if the stock price went up to that short call strike price with the next 60 days, and it was right at 160 at the time of the short call's expiration, the profit on this position might actually be higher than $1,800, since that long 100 call that's expiring in November of 2022 would still have about 130 days until expiration. And so that's going to have a lot of extrinsic value remaining, or at least it's going to be trading at more than intrinsic value. And what that means is that this overall position could have a profit of more than $1,800. So these are my two guidelines. The first is to buy a deep in the money call option with a delta over 75 as a starting point, and then also target an expiration with 120 to 180 days to expiration, but you could get away with buying a 90-day call option. And then for the short call, I would first target a delta of 0.35 or lower and less than 60 days to expiration, so that we know that that position or that short call is going to be decaying at a decent rate, as opposed to shorting a 90-day or 120-day call as part of our PMCC position. And by using a 60-day short call option expiration, that means we will more frequently be able to adjust where that short call strike price is. So for example, if Apple is at $155 in 60 days, then I'll be able to close this short 160 call for maximum profit, and then I will be able to short a higher strike call option, perhaps a 170 or 175 short call option, and collect more premium in the trade. And by collecting that additional premium and resetting the strike price higher, I will actually be increasing the maximum profit potential of this entire poor man's covered call package. Is there early assignment risk when trading poor man's covered calls? Yes, you do have early assignment risk, because any option position with a short option component has early assignment risk. Since you are short that option, you do not get to decide when or if that option is exercised, because that decision lies with the option owner. So if you are trading a poor man's covered call and your short call becomes super deep in the money, or it's in the money with very little time until expiration, then there's a chance that that short call is going to have very little extrinsic value, meaning it will have higher likelihood of being exercised by the owner, and that means you will be assigned or have the potential to be assigned as the short call trader. So the one thing you have to look for is how much extrinsic value does that short call option have. If the stock price just barely gets over that short call strike price and your short call has 30 days left until expiration, you are not going to be assigned in that option, because most of its value is going to be extrinsic. And that means if the person who owns that option exercises that option, they will be basically throwing that entire option value in the toilet and just wasting money for no reason whatsoever. Just look at the extrinsic value of that short call if it is in the money, and if the extrinsic value is close to zero, then you do have a decent chance of being assigned early on that option. I did a whole video on why you should not worry about early assignment in most cases, and you can watch that video by clicking on the card right up here or checking the link in the video description below. The one exception to this is that if the stock price is paying out a dividend in the near future and your short call is in the money, then if the short call that you have has less extrinsic value than the amount of the dividend being paid out, then you have high risk of early assignment on that option, and you should probably close that short call option before the ex-dividend date. Or you can just close the entire poor man's covered call position and get out of the entire position, just to avoid any potential headaches of being assigned stock on that short call option. The last thing I want to talk about is the tax implications of trading a poor man's covered call versus a covered call. In this video, we've talked a lot about the benefits of trading a poor man's covered call. When it comes to taxes, the poor man's covered call is definitely disadvantaged compared to a traditional covered call, because you are trading options, and options have expiration dates. And when you're trading a poor man's covered call, more than likely the long call that you're trading has less than 1 year until expiration. So for example, if you bought a 180-day call and shorted a 90-day call, and the stock price is increasing over those 180 days, then after that 180-day period, your long call is going to be reaching expiration. And if you have a profit on that long call portion of the trade, then you're going to have to sell it to initiate a new poor man's covered call, or simply take your profits. And since that holding period was less than 1 year, that means that all of your options profits from that poor man's covered call will fall into short-term capital gains or profits that occurred in less than 1 year. The advantage of a covered call in this scenario is that with stock, you don't have to ever sell your shares of stock. So if you're trading a covered call and you're holding those shares for over 1 year and you never get assigned on that short call, then at the time of selling your shares, whenever you do, if you sell those shares for a profit and you were holding them for more than 1 year, then all of those profits will be falling under long-term capital gains, and that is going to be a lower tax rate than short-term capital gains. So there's definitely a big disadvantage of the poor man's covered call relative to a covered call, and that's because with a poor man's covered call, most of your profits, if you have them, are going to be short-term in nature, and you're going to have to pay more taxes on those than long-term capital gains. Next up, I would definitely recommend watching my recent video, Vertical Spread Option Concepts That All Options Traders Must Know, because in this video, I talk about the core concepts that if you understand will take your options trading IQ to the next level for sure. So definitely consider watching that video right now.